So to start with, we need to understand your P&L and reporting. P&L, does anyone know what P&L means? Profit and loss. We need to have your profit and loss. Now that isn't waiting for the accountant to do it 9 months after the end of your financial year, because that's typically what a lot of people wait for, because that's a year and a half out of date information. What we're looking for is a monthly P&L that you're updating and reviewing and understanding. Because off of that P&L you can understand A, what your profit is, but most importantly you can also understand what your margins are, because from that you can work out what your costs are, yeah, and how much they are, and then what your sales are, and where your costs and your sales cross over there, that is your break-even point. And after that, this is the good news, this bit is where you make your profit. So you need to look at and understand, when do we make profit? And then if we're making profit, how do we add more profit on? How do we add extra things onto those sales so that we can make more profit? What else can we be doing? So it's very important to measure. Have you ever heard what gets measured gets done? Yeah, so you've got to measure it so you can see what's happening. So typically your financial information is used to provide historic information. Do you know who you're actually doing your P&L for? Does anyone know? This is not for yourself. It's for the tax man, absolutely right. They just want to ask, how much money are you making so I can tax you? That's what it's all about. So it's a useful document, but it's looking historically. The other thing you've got to do is look to the future. What else is actually looking to the future in terms of financial information? It's called a cash flow. So you need to be looking out at least 12 weeks, seeing what's happening, what money's due in, what money have I got to pay out. So you're in control, you know what's happening. Has anybody ever written a cheque, crossed their fingers and hoped that it's going to go through? You see, that is not a good way to run your business. All right? So most businesses, their businesses fail due to a lack of information. They're not an unprofitable business, they just run out of the cash, and I'll show you the cash gap in a minute, but they just run out of cash. So if you want to improve it, if you want to manage it, you've got to measure it, you've got to start noting it. And the other thing you can start doing is start picking up some what they call KPIs, key performance indicators. These will be things in your business, they'll be the certain drivers of your business. It might be the number of quotes you do, might be one thing, and the number that actually convert and you sell to. So, you know, there might be some of the KPI numbers that you might need. Or it might be footfall, how many people walk into the shop. Or it might be hits on your website, how many people, you know, whatever. You need to work out what the KPIs are that drive your business. And that, you know, you'll know the health of your business by looking at those KPIs. And the other thing we've got to look to is the budgeting and reporting, which is the future stuff. Looking at, I'm doing my budget. What do I expect to be coming in? That means you've got to start doing a pipeline. And a pipeline gives you ideas of what money am I due in? You know, what clients do I think will convert into sales from my pipeline, so I've got a good estimate of what's coming in. Also, I've got a budget in place, which means I know when you do negotiation with people, if you say, oh, it's not in my budget, even if you haven't got a budget, right, when you're negotiating with anybody over products, you know, or things that you have to buy for your business, you say, oh, it's just not in the budget, we haven't got that for the budget, and you better sharpen your pencil, and people just go, oh, okay, it's not in their budget, we better see what we can do. And you know, if you use budgeting, you start planning out where we think we'll spend our money and where we think the money's going to come in. So, and then the reporting is, how do we display it? And one of the things to do is to look at, how do I display it? You know, have I got some kind of dashboard, information? You know, am I got my graphs, my charts? What am I? How do I actually know what's happening? Is it just a basic spreadsheet, but at least you can look at something? Then you start looking at debtor and creditor control to make sure that once you've sold stuff to people, you're getting the money in for it. I literally had one client once, and they used to make stuff, machine tool, you know, big milling machines, turning machines. I used to make things for people. He used to love making stuff for people, especially when they had a panic. He'd love throwing all the team at it and making all this stuff. The bit he hated was using the accounting software and invoicing. which was crazy because there was about 110 grand's worth outstanding when I got there. So what I did is I got them to hire straight away, basically a credit controller, get on it, and like we just had a temp in there. Within 2 months, he'd brought in over £100,000 worth of debt that was outstanding. People were getting annoyed that he weren't sending an invoice because they wanted to pay the bill. You know, it's crazy. You don't get the invoice. Some people then go, well, if you can't bother to pay me, you raise an invoice for 3 or 4 months, I won't pay you for 3 or 4 months. Yeah, so make sure you're on it with your invoicing, so you know when you've done the job, invoicing goes through. When you're checking the invoice has gone out, make sure it's in their clients, make sure they've received it. Because the old trick is, oh, I didn't receive it. Yeah, make sure they've received it. Make sure it's in their process. So, looking at the past, we're looking at things like a profit and loss, and we're looking to the future, we're looking at the budgets and the forecasting. We're looking at some financial ratios, things that, you know, you might go like, well, what's the ratio of employees to turnover? You know, and it might be that if you've got, I know that, you know, one of my clients is nursery, they've got like 50-odd%, which is a big wage bill. Usually you want to try and keep it under 30 if you can. Just like some litmus test ratios. So as I said, you can have basically a spreadsheet. There's your month on month, and then you've got where does my money come in? So that's my sales, and then you've got what are my costs of goods sold. So if you sell something, then obviously there's stuff that you have to buy to produce it, or pay people to fit things or install things or whatever, and that gives you your cost of goods sold. That minus that then gives you your gross profit. A lot of people talking gross profit, and that's because it's a bigger number and it sounds great, but it's only vanity. Well, if they're really vain, they talk in turnover, which is crazy. Then gross profit is the kind of vanity thing. What you really need to be talking is net profit. You then take away all the fixed costs in your business, and you end up with how much money is actually left. Yeah, and that's the important one. And if you really want to be clever, it's net profit, because that's after you've paid dividends and your tax. What is truly left in the business? So you've got to understand your numbers. You can have a basic spreadsheet like this running. That's just as good, you know. It doesn't have to be a complex software tool. However, I use Xero. I know Ricky does as well now. Has anybody else used Xero? Yeah, Xero is a brilliant piece of software. You've got a piece of, there's this thing called Float app. Yeah, which allows you to actually kind of demonstrate all this stuff with a KPI dashboard and do cash flow forecasting on it and all sorts of clever stuff, which is really nice. The great thing about Xero is it's got bolt-ons. You can just bolt different applications onto it.
You can do latency tests on that as well, can't
you? Yeah, so you can, you know, it might say that people are going to pay in 30 days, but you know they're always 45, so you can actually adjust it to that. Okay, so here's the important thing for people who give away a 10% discount. This is why it's really dangerous. In your business, you've got, this is your costs, this is your profit, if you're lucky here, 40%, if it's a gross profit. If you give away 10%, you're actually giving away not 10% of the business, but that is 1, 2, 3, 4, 10s in 40, right? Give away 10 as a percentage. What is that you've just given away? You've been left with 1, 2, 3. A quarter, which is 25%. So for that little 10% you thought you're giving away, you're actually giving away 25%. However, if you add 10% onto the price of what you're doing, and it's amazing how many people think they're too scared to do that, but when you do it, nothing really happens, you'll find you're making an extra 25% profit. And that's how you can start building up that extra profit in your business that we're looking for. So that's that. Let's say you're on a really tight budget here. Let's say the gross margin is 20%, and you're giving away 10%. You're actually giving away 50% of the business, half of it. Be very, very careful. You've got to know what your profitability is of your business, and then be very careful about those discounts that you give. So that's just a little note there. And not all customers are equal. So here we have a list of customers. You'll probably find the old 80-20 rule kicks in. Your biggest customers, the regular ones or whatever, 20% of your customer base will provide 80% of your revenue. That's usually the way it works. So make sure you know who they are and look after them. It might be someone who just regularly refers business to you. It might not be a client as such. It might be a strategic partner that you've got or something like that. So make sure you understand, not all customers are equal. Now what you do is you spend 80% of your time looking after these and 20% of your time looking after them, and in that 20% you're looking to find the next one or two that are going to drop into this area. Yeah. So then we go on to that KPI dashboard, how are we monitoring and measuring what's happening? So you get yourself a dashboard in your business, looks something like this. I mean, it could look like anything you want, but a dashboard to start measuring sales or profitability or customer retention, or might be failures or first time deliveries or whatever it is that drives your business. You've got to understand what they are and then measure it and then look at it in an easy to read fashion like this. So simple things, there's all sorts of examples. You could have lead generation, conversion, sales, pricing, channel mix, sales value, transaction value, how often are people coming back to you, utilisation, that's a big one. We were talking about utilisation the other day. You don't have to open another shop, another fencing building place. We can just extend the hours, do an early shift and a late shift and create more stuff. You can get more out of what you've already got. Then you obviously get a financial controller in place in your business. That's somebody who's helping you do all the bookkeeping and all that. Now I outsource all of mine to All Tax Accounting. They do it all for me. They do all the bookkeeping, all the financials, all the information, so that I don't have to worry about that. I just want the information. Give me the information. That's what I want. I want you to manage it. But until you've got that, you either bring somebody in house and have like a bookkeeper or an accountant, or you do it yourself to start with. But when we start freeing up your time and doing that, leveraging yourself and doing it through delegation, then you actually can start taking somebody on to help you. And ultimately, it's all about managing the cash gap. So let's say, here we are, we've got St Neots Fencing, he buys some wood, fence panels to sell. There we go. You buy them and you pay for them, because you're a good person, you pay for them within 30 days as it says in the agreement. You hold on to the stock for 60 days. It takes a little while to sell all these fence panels. There we go. You sold one. Unfortunately, the person who says they're going to pay you in 30 days drags it out to 60. This is usually what happens, especially in the building trade and stuff like that. So your cash is received at day 120. You've got a 90-day cash gap. That means you need to fund your business for 3 months. You've got to know what the fixed costs are. You've got to be able to open the doors and pay for it for 3 months before you get your money. And that is the challenge. It's the cash gap. It's holding stock. It's not turning stock. It's not. And what you've got to do is reduce that. So you can reduce it by getting people to give you some money up front. That would be helpful, wouldn't it? 50% up front or whatever, do that sort of stuff. You can get people to pay on time. You can have decent credit control and chase them and bring it in. It's all about bringing that cash gap in. And ultimately one day you hire a financial director to work for you as your business becomes so big you need somebody who manages all of finance, and any number you want you tell them, go get me this number and I want to know what it is, and they figure it out. So that's the 5-star business. So a few tips on improving cash flow. I'll leave it on the screen, but things like make sure you got your cash flow forecast. Get people to pay by either standing order or direct debit. I use Go Cardless, it's brilliant. People can pay on direct debit. You don't have to worry about it. So there's different ways of doing it. Get rid of your D-grade clients, because your D-grade clients is absorbing all your time and your margin, getting you running around and wasting time in your business. So there's a few things there.